Hi guys, and welcome to Symax Fintech weekly market report. As usual, just start with our trade disclaimer. So, trading involves potential loss of risk of capital. It's not suitable for everyone, hopefully for you though. And as many companies will provide leverage, just be aware you can lose substantially more than that initial investment. All the views, information provided in this is just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And before you make that decision, you should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, seek professional advice before you start risking your capital. Okay, so quite a lot went on last week. So the highlight, stock struggled after the previous week's really good rally. It just ended lower last week. Although last week, it did have a bounce on Friday, it just struggled. They just didn't look as though they wanted to go up, really. And of course, the dollar remains under pressure. And weaker data, concerns on the debt ceiling, which was reached on Thursday. Yellen has a workaround for the moment, but that is only for the moment. It's just politics, though. So usually they eventually do some false trading and get it sorted. So we'll have to wait and see. But it's chunky. It's over $31 trillion. Okay, so gold ranged about $30 range in the week, and it closed above 19.25. Oil again had another steady week, about $82. And with part of this is demands from expectations of what's going on in China. The reopening, increase in demand. Just be aware that over the weekend, a Russian oil depot was sabotaged, and that was inside Russia. So whether that will sort of cause a little bit of panic spike on the opening, I don't really know. It depends how people see that. Fed speakers, there was plenty of them, and they had mixed views on the rates. Some are still pushing for higher rates. Others are saying that it should be perhaps only quarters. Others are saying maybe we should stop for the moment and see what's going on. So a little bit of a combination and mixed views there, I would say. Data-wise, manufacturing dropped. Retail sales were lower, so again that's just showing that slowing in the demand from consumers. PPI was lower, so again the inflation's still slowly dropping down. Now capacity utilization 78.8. Now between 80 and 84 is growth, it's demand. So you're seeing that trickle lower and lower. If it was to get to about 74, that really is starting to tell you that there's a contraction going on. The demand's just really dropping out of the market. So just keep an eye on that. It's one that I like to just keep an eye on because above 80 is growth, 84 is sort of almost maxed out. So yeah, we're off the highs for sure. Let's just keep an eye on that one. Moving on to the EU CPI headline, below 10%, 9.2. It's going in the right direction, isn't it? But so slowly. And then German CPI back below 10 as well at 9.6. And the ZEW was better than expected. That's just sort of how the Germans view their economy. Moving on to the UK, employment 3.7%, so that's still really good low unemployment there. Earnings at 6.4%. Now that's again inflationary, so we've just got to keep an eye on that. CPI, the headlines came in at 10.5%. The core 6.3%, still a long way away from the central bank's desired 2% target for sure. Retail price index was lower, but it's still up 13.4% year on year. In China, GDP 2.9% year on year. Their retail sales have dropped. I suppose with the reopening, we should start to see that become more positive though. And they held rates at 3.65%. This week is their Lunar New Year. Millions of them travel everywhere. Their markets are pretty much closed. Now, I would say that the Bank of Japan policy and leaving the yield curve unchanged did surprise a few investors, and it took some of the heat out of the yen that started to drop off after that decision came out. And then Canada, their CPI, the core was lower at 5.4%. Okay, so now we're sort of just moving on and looking at what's coming out this week. Just keep an eye, there's still more earnings reports to come out for Q4 of last year, and they should pick up pace. We've seen the banks and such, but there's going to be a lot more coming out this week from various sectors. And then from the US, we've got lots of data. So we've got the PMI, manufacturing, durable goods, GDP, the one that the Fed really focus on, PCE, and then housing data and Michigan sentiment. In the UK, again, PMI's out again with PPI. And in the EU, we've got consumer confidence with PMI. Germany's got their IFO coming out. Canada, we're going to get their rate decision. Again, maybe expect another perhaps 0.25% increase there, but they're possibly coming towards the end of them at the moment. China, just remember Lunar New Year, so there won't be much at all come out from there. Apart from massive travelling, millions and millions of people travel. Most inside the country, but some outside as well. When I go and see friends and family to celebrate. Australia, CPI and PPI, so we're going to see inflationary data there. Okay, so looking on at the macro outlook, inflation easing, is it really? It's just so slow, isn't it? And it's still just well above that 2% level. So yeah, you can see central banks reducing their aggressive rate hikes. Are they going to stop them? Some yes, some perhaps not. America's probably getting, they've been ultra aggressive. They're probably coming towards the end of theirs. And at the moment it's data sensitive. So if they see that the data's weakening, they're going to be more arguments for not putting rates any higher. And if the data comes out strong, then the arguments are going to be there for them to keep adding probably additional quarters for a while. I think all the big stuff's done in the US now. I think any increments are going to be in quarters going forward for this year. But, I'm going to keep emphasizing this. Even if we start to see inflation dropping, people are expecting the US to turn around and change policy way too quickly. Even if, 2% inflation is still a dream at the moment for the US. When it gets there, they're still going to want to see that remain constantly there for 3 to 6 months before they're even going to consider any rate cuts whatsoever. This is obviously just my personal view. And therefore, I really don't see any rate cuts in 2023. I honestly don't. But, just remember, that's only my opinion. I can be wrong. Now, stagflation is around, and that's probably going to not so much take the place of recession, but it's going to be the preempt for any recession that's going to be around. Stagflation is just inflation without growth, and we are going to start to see that for sure. Recessions themselves, last year even I was sort of saying that they could be deep and they could be long. But you know, again, markets change, sentiment changes. Even my sentiment is changing a little bit on that now. Yeah, yes, you know, there could still be recessions. You know, I'm in the UK. The UK could still go into a recession, and a few other countries will as well. In Europe, we've had the benefit of mild weather, so that has sort of reduced the uh, energy prices, you know, for gas, for electricity and such like. And that has been a godsend for Europe for sure. It's taken some of the inflation away, obviously not all of it. There's still a lot of food inflation out there, and I just see a lot of that as profiteering, as I've said in the past. You know, you know, a lot of commodity prices are back down again. So yeah, there's, you know, there's wage pressures, uh, and energy is still more expensive, but does it warrant the fact that prices for food are remaining at the highest levels, rather than dropping at all? And for me, that's the food companies and the supermarkets actually taking advantage of consumers. So, you know, obviously I'm not happy about that, but what can we do? We all need to eat. So at the moment, any recessions could be shallower. They could be shorter than was originally feared last year. But you know, these rates aren't going to drop. So disposable income's still going to be short for people. You know, people are having to make those hard decisions. There's a lot more credit card spending now, even for necessities. So you know, and then supply chain issues, China. No, okay, so China's reopened, which is fantastic. But you know, it's having an impact. There's a lot more deaths out there, unfortunately. There's a lot of people having to isolate because they've got COVID, because cases are continuing to increase, despite the fact that the comments coming out are saying that they have peaked. I don't believe that. I really don't. And with Chinese Lunar New Year now, I think that's going to spread cases considerably. So just bear that in mind. But again, with the China reopening, it's going to increase demand, which again is inflationary. So, you know, that could bring back a little bit of inflation and upset the central banks even more. And, you know, the fact China's opening up could be good for Germany as a country, because the Chinese love quality goods, and the Germans are famous for that. Of course, the isolation danger that I mentioned can also damage supply. So again, that becomes inflationary because there's less supply around. Now, you know, Lunar New Year, there's tens of millions travel. A lot of it's internal, so again, that's going to spread COVID. A lot of them will travel. The Chinese will travel abroad as well if they can to see friends. Now, of course, you know, it depends which countries they're entering, because some have these restrictions. They have to provide this 48-hour test to prove that they're clear of COVID before they're allowed to enter a lot of countries. Uh, but you know, a point here as well with the Chinese is that where they have been confined, okay, the governments haven't sort of thrown money at the households the same as what's been happening in other parts of the world during COVID. However, you know, they do have savings, household savings of around about $720 billion. Now, how much of that is going to get spent? Okay, that's only just over a third of what the US managed to save during COVID. But you know, if the Chinese go out, that's going to give that inflation another little upward pressure, I would say. Uh, Russia's invasion of Ukraine, so Russia's preparing for, and you know, they're gaining a lot more confidence because they're taking another ground force to try and battle against the amazing job that Ukraine's doing. And you know, they've still been doing their aerial drone strikes and missiles and everything into Ukraine. And of course, you know, that does have an impact on their water and their power supplies, which is obviously what they're trying to, the Russians are trying to sort of damage to a point where it makes it more of a problem for Ukraine to fight, just reduce their resources. On the other side, you've got lots of countries that are committing to send weapons to Ukraine, uh, with the exception of Germany at the moment. They won't send their, I think they're Tiger tanks they're called or something. They're refusing to do that. So again, that that's sort of putting a little bit of pressure on Germany. Some people may decide not to buy their goods and stuff like that. Obviously, that won't impact China, though. Now, energy and food inflation. So, yeah, energy, the weather's been that little bit more warmer than expected seasonal in Europe. That's been a good thing. But, this food inflation is still there. Now, if we sort of look at the dollar, so the euro against the dollar, uh, it's been positive for the euro, and the fact that Lagarde is sort of highlighting and reinforcing comments that they've still got further to go with their rate hikes. So where the US is slowing down, the ECB may keep going that bit further. Uh, they're not going to catch up to the rate of the US, but investors see that as well. They can attract more investments into Europe, possibly because of the rates going higher. Now, with that, I think that just be a little bit careful because I'm one of my favourite trades for years has been selling the euro against the dollar. But I'd be very cautious. To be honest, I haven't done it this year, and I didn't do it towards the end of last year. And that dollar's been weakening. I mean, the dollar index was up at 111, and it's sort of around the 102 and is slightly below at the moment. So, but is the dollar collapse? No, I don't think so. It's going to be a point where, personally, I see that it could start to recover. At the end of the day, they've still got the strongest economy. And talking about such like China now is actually reducing in population. And it's possible that India is now the biggest population. I think it's sort of pretty much even at the moment. But India is still increasing their population. It was expected for that to happen around about 2030, but it looks as though with the situation going on, it could actually happen this year, where India becomes the new biggest population in the world. As I mentioned, Russia's going to send in fresh conscripts to try and regain ground against Ukraine. Employment. So we've still got that lack of workers. And that's despite the banks shedding staff and tech companies shedding staff. But other sectors are still holding on to their staff. And I think part of the reason for that is it's been such a challenge for them to find them. And whether that will change in the future is going to depend on obviously performance. Whether the companies can afford to keep that staff or not. And I think really for that it's going to depend on if inflation continues to fall, or if China's demand increases and gives inflation another spike. The governor of the Bank of England, Bailey, said that it looks as though inflation spiked. Well, at the moment, yeah, probably. But just bear in mind, April, the energy cap that we have in the UK will increase again. So that will give another little spike to inflation around April. Although, if energy prices remain in the direction they're going and going along at the same rate, then probably by Q3 of this year, energy prices will be very close to what the UK is paying now for their energy. So the fact that it's increased won't have that much of an impact. But I think in April it will have a little spike on inflation, the fact that it's going to go up. So just be warned of that.